Hello and welcome back to another video. Following on from the previous video that we did together, it's quite a long one, and off the back of that one, it's safe to say we had a lot of questions, I think.
And a lot of questions.
So what we wanted to do today is take some of those questions, the most frequently asked ones, and then come back to you. So it's effectively your questions are being answered in this video. We'll get straight into it. What's the difference between an SPV and a limited company?
Okay, Justin. Well, an SPV is a limited company. The only difference I can see is it's got a different name. It sounds a bit more glamorous. But the only real difference is the SIC code. So with an SPV, you're talking of an SIC code of 68209 or 68100, buying and selling of your own real estate or renting out of your own real estate. Those two things really matter, because if you're going to go and get mortgages on the buy-to-let properties, the mortgage companies want to see that the company can just do that one sort of transaction. So that's the only difference between an ordinary limited company that you see around everywhere and the SPV, which is just an ordinary limited company with a different SIC code.
Okay, that's interesting. And what does SPV stand for?
Special Purpose Vehicle.
Yes.
I think it actually sounds for where lawyers can charge a bit more for creating something that sounds a bit more technical, but it's just a limited company.
And am I right in thinking, or is this something I perhaps got wrong or picked up wrong, that usually an SPV is for a shorter period of time, or someone might be using that to perhaps to potentially buy a development or a flip project? Is that more common, whereas like a limited company might be for a long-term buy-to-let portfolio?
I must admit, I don't see it like that. I see the SPV as say it's lawyers selling a particular sort of product. So they're saying, like, this company is specifically for buy-to-let. But all they're doing is just choosing that one SIC code, which if it was another limited company, let's say it was a motor garage, you just choose the SIC code for a motor garage. So there's nothing very technically different, no technical difference between the two, just the SIC code. Okay,
well, thank you for clearing that one up. Next question, do I need to have a separate bank account for my company, and does it need to be in the company name, the same company name?
Absolutely, Justin. The limited company, the way it operates, the way you save tax with that limited company, means that all of the assets of the limited company have to stay inside the limited company. So it's very, very important that all the money that goes into the limited company goes into a limited company bank account in the company's name, and it stays in that bank account. If you just use any old bank account, that money isn't inside your limited company, and you're now paying all the taxes that any individual in the UK pays. You're not getting any of the advantages of your company.
And it's safe to say if you start sending money backwards and forwards between your limited company and yourself, your accountant's going to slap you on the wrists, probably.
Well, you're going to lose a lot of money in tax. It's a really daft thing to do. You've got to understand how your limited company really works.
So run it as efficiently as possible as a separate entity, have that bank account separate, and again, talk to an accountant, talk to your accountant, which could potentially be Peter, and ask him the most tax efficient ways of running that company and withdrawing wages or salary from that company if you wish to do so. Next question, what's the difference between a director and a shareholder?
Okay, so when you form this limited company, Justin, you've created a separate person in law. It exists like another person, like you or me. It has a birth certificate, a certificate of incorporation, and it exists as a separate person. The directors of the limited company, you will be a director of the limited company, they're the employees. They're responsible for running the company. So as a director, you're simply an employee of your limited company. On top of that, you're also a shareholder, which means you're an owner of that limited company. And you sit with these two separate hats on: director, employee, shareholder, owner. And as you take money out of the company, it will either come out as a director or it'll come out as a shareholder. And they come out with entirely different tax effects.
Okay, and would you, for someone that's brand new into property, it might be a difficult question to ask without knowing their personal circumstances, but if they were looking to start a small portfolio, is there one that you would particularly recommend over the other? Would you recommend and say that you need to be put yourself down as a director or as a shareholder?
Yeah, well, it's pretty obvious. As a director, you're just working for the company.
Yeah.
So, where you work, you're an employee, and you are just an employee of that company. As a shareholder, you're the owner of that company. You own all the assets inside that company.
Yeah.
So you'd probably choose first to be the shareholder because that's the person who owns everything. The director simply works for the company.
Yeah.
So definitely you want to make yourself the shareholder.
Yeah.
And you may well choose to make yourself the director. In most of these buy-to-let companies, you are the director and you are the shareholder.
Okay. Good. Well, thanks for covering that. I think it's important to potentially cover the basics for anyone that's brand new to property and looking into opening a limited company. One of the next questions is, can I include my children as shareholders and directors? I guess off the back of that last one.
You technically can include your children as shareholders. I'm not so sure you want to include them as directors if they're sort of 7-year-olds.
Yeah.
You don't want those people responsible for the company. Technically, you can include them as shareholders, but there are some big downsides to that. I often see people come along and say, I've got my 2 5-year-old children, I want them to be shareholders of the company. Now, you can get to that point, but you then got to remember that the shareholders are the owners of those companies. So at the moment, they're 5 years old and they're not too responsible for those companies.
Yeah.
But let's say when they're 20, and you've given them a quarter of the company each, the 2 children, and you have a quarter each with a husband and wife, they now own half the company. You've grown that portfolio into a much bigger portfolio, and you can't tell what your children are going to be like at the age of 20. They could be completely responsible and everything could be great, but they could be completely irresponsible. They could have gambling habits. They could be spending wildly, and you could end up with your children actually losing all your property portfolio.
Yeah. Okay.
So I think that children can be put on as shareholders, but you must be careful about it.
And without necessarily going into the rabbit hole in which people could structure that differently, there are other ways to structure that if you wanted to incorporate your family as part of your portfolio down the line, or?
Yeah, there are various ways that are described to structure it. For most of our clients, we don't use those things. There are routes that you can set up different classes of shares for the children, but all of them in some way have some problem in the background.
Yeah.
And they also rely on no tax changes going forwards.
I see.
So technically you can do it and it might be better,
Yeah.
but I actually prefer that having the ownership in the people who've invested in the buy-to-let, so in the husband and wife or in the shareholder, just that one person having the ownership.
Yeah.
And then we'll worry about the taxes sometime in the future when you want to transfer some value to the children.
Yeah.
It's just too difficult to predict what tax rules are going to be in the future.
Yeah, exactly. You've covered a very valid point there, and that is that the government and the tax rules are always changing, so you can't really plan 10, 20 years down the line. So now I just wanted to touch on something I get asked quite a lot, and that's with regards to, with reference to how people can pay themselves. I think when it comes to owning a limited company and buying properties in it, I think it's important to start that company off with the idea in mind that you're going to build that portfolio up. Personally, I do. But I know a lot of people straight away are thinking, right, well, if I do own and open a limited company, how can I withdraw money from that further down the line? So the question I guess I wanted to ask, what are the different ways of paying yourself from a limited company? If we start with that, and if you could cover the different ways, and then maybe I can ask you a couple of questions on that as well. Yeah,
of course. So there are really only 4 ways that you can take money out of that limited company.
Yeah.
So the limited company, the income from the rents, they're going to be in the company's bank account. Mm-hmm. There are only 4 ways you can take that money out of the company's bank account and put it into your own bank account.
Yep.
The first 2 ways are as a director of the company. As a director, you're an employee of the company, and the first 2 ways you take out as a director. The first way is as a wage. So if you're going to take a wage from the company, you're going to be subject to PAYE, pretty much the same as you working for your employer. You have a wage, tax and national insurance is deducted from that wage, you receive the net, and on top of that, your employer, or in this case your buy-to-let company, has to pay employer's national insurance on top. So if you took your money out that way,
Yep.
it's going to be pretty expensive. You're paying 20 or 40 or 45% tax on it. You're paying 12% employees' national insurance, and you're paying another 13.8% employers' national insurance. So for most buy-to-let owners,
Yep.
they're not really looking at taking out that money as a director's wage. The only exception to that might be if you now stop working, you had no other income, then you might choose to take a wage. But that's the first way you could take money out, as a wage. You have to remember, when you take that money out, PAYE is a real-time information system. So if you're going to take the money out that way, you have to tell HMRC on the day that you take the money out.
Okay, that's interesting. I didn't know that. So,
second way, pretty much the same as you probably submit expense claims to your employer at the moment, Justin. You can put an expense claim into the company. So you go off and buy a tap from B&Q for the buy-to-let, and you pay for it personally. At the end of the month, you put an expense claim in for that tap. The company then reimburses you that money. And they're the only two ways you can take money out as a shareholder, as a director, as an employee of the company.
Okay. Yep.
The third way that you can take money out of the company is as a shareholder rather than a director. And as a shareholder, you're entitled to a share of the profits of the company. And that share of the profits is called a dividend. And so if you take a dividend out of the company, there's a process that has to happen in the back of the company. You as a director have to decide that the company's made enough profit to declare a dividend to the shareholders. When you're looking at that, you've got to make sure that the company can pay off all its debts, and because these dividends have to come from earned profits. So the dividend can get paid. There's a need to minute down that meeting you had as a director. There's a need to produce dividend vouchers, and then that dividend can be paid to the shareholders. And you've got to bear in mind, if you had, say, 2 shareholders, 50% each, that's one dividend to one shareholder and the same dividend to the other shareholder. But that's the third way that you can take money out of the company.
And would it be safe, just before we go on, to say that because of you have to do that directly from profits, once you've paid all your liabilities, it would be done after the previous year's tax return?
You don't have to do it after the previous year's tax return, but the previous year's tax return or previous year's accounts will show you what reserves you've got there. But you can do that looking at the company's current information. So looking at the sort of internal accounts that you've produced, and you can pay it from there. Now, when you do pay that, you've got to remember that for every individual in the UK, £2,000 a year of dividend is free of tax. And then after that, if you're a basic rate taxpayer, you're paying 7.5% tax extra on that dividend. So the company's now paid 19% on the profits, and you're paying an extra 7.5%. If you're a higher rate taxpayer, which we find a lot of your buy-to-let followers are, you've got 19% tax in the company. You draw out the dividend, and there's another 32.5% tax to pay on top on that net figure. So that means by the time you've taken that dividend out, you've got roughly 45% tax on that money from earning it in the company to taking it out. So it's equally as expensive as earning it personally. So that's why your idea of building up a portfolio and keeping the money inside the company works, whereas someone who really wants to just earn this money, take it out and spend it, the company is nowhere near as tax efficient for those sorts of people.
I think that's very interesting for people to know as well. And then
the final way, you can take it out as a shareholder, one-way dividends, director salary or expenses, and the final way you can take money out of the company, which is probably the most likely way you're going to take money out. The initial loans you give to the company to get the deposit for the first property or further properties, those loans have been given to the company from your taxed income. And so you're entitled to take those loans back tax-free. And so that's probably the most likely way that you would actually take any money out of the company. It would just be drawing back those loans. Now, you can't take more than those loans. So if you lend 20,000, you can have 20,000 back.
So that's known as a director's loan.
A director's loan, and you need to record that down in the company's books. And then as you take the money out, you record down the repayment of the loan, so you can measure what that loan balance is at any stage. Because if you take back more than that loan, you're going to cause yourself tax liabilities.
And then a quick question on that before we move on a bit. in terms of when you've loaned that money to the company, say I did it 2 or 3 years ago, and I've left that money in there ever since, can I come back 3 years later and still withdraw that tax-free?
Yeah, that loan exists as a loan until you take it back. This is why we use, say, QuickBooks to record down all the transactions, because when you put the loan in, the loan gets recorded at the £20,000, and then in a year's time you might draw back £2,000. That now gets recorded at 18. A couple of years later, you draw back another 10, comes down from 18 to 8. And you still know what balance you've got, so you can do it in chunks.
Okay.
And the other point about that, and the dividend point, is quite often you see people taking that £2,000 tax-free dividend out of the company, and then immediately lending it back to the company. Because in doing that, you've actually managed to up your director's loan, the money you can take out tax-free, by £2,000. And you haven't taken any money out of the company.
That's brilliant. So because you're reinvesting it, that's just increasing your director's loan. So you might put £20,000 in the start. A year later, you withdraw £2,000, tax-free dividend, and then you reinvest that. So you've now got a total of £22,000.
That's right.
That you can withdraw tax-free. Yeah,
and of course, if you're doing it husband and wife or 2 shareholders, that's £2,000 each. So you've gone from 20 to 24.
Brilliant. Okay, and I think that more or less covers the different ways in which people can.
Yeah, so all those other ways, going and putting your Tesco shopping on a company bank account, just drawing out money that you decide to take from the cash point. All that's ever going to do is get HMRC to treat that as if it's net pay, and it's going to cost you a lot in tax.
So, and that brings us on, I guess actually we'll cover on this slightly, because you put this in quite a good way to me earlier, that when you're running a business, when you're running a limited company, it's very important to treat that like almost like a separate entity, because the minute, and I think you can give a good analogy on this, but the minute you're taking that out of the company, you're hit with the tax formality, essentially.
That's right, yeah. So, the way I sort of explain this, we all live in the UK and we all have to pay taxes up to 45%, and we have to pay national insurance on top. So it's pretty expensive for us in terms of taxes. Your company is like a little island inside the UK. So it exists inside the UK, but on that island there's a special tax regime. And that special tax regime says that the maximum rate of tax at the moment, the maximum rate of tax you could pay on that rental income or sale of properties and the gains on them, the maximum rate of tax is 19%. Whether that profit's £1 or it's £1 million, you're never going to pay more than 19% tax on it. But that only applies as long as that money stays on that island. As soon as you want to take the money off the island and spend it personally, draw it out of the company's bank account and spend it personally, then that's the point that you have to pay all the taxes that everybody else pays in the UK. Yeah. So your idea, just building up this portfolio and reinvesting the money that's inside the company, that's the only way that you keep it all at 19% tax. If you want to just go and spend it, you want to earn it and spend it, you're going to be paying the same sorts of taxes as everybody else in the UK pays.
Brilliant. So the longer you can keep it within that business, reinvest those funds, the longer you will be paying just the 19% corporation tax. And then further down the line, once you have built this portfolio and efficiently used that business, then you can worry about the tax that's involved in withdrawing that money personally when you want to take that money personally, or that's the way I see it.
Yeah, at the moment, no one knows what the tax rates are going to be when you want to take that money out personally. But if we assumed you'd started this portfolio 20 years ago, it had now built up into a nice big portfolio, and you had got to the point you were thinking about taking it out. Maybe you've stopped working and you've got no other income, and you've got your company there earning this money. We know today you will be able to take £12,000 or £12,500 out as a wage, as a salary, as a director, and no tax on that. A little bit of national insurance, but no tax. And you could probably take another £37,500 out as a dividend and just pay 7.5% tax on £35,000 worth of that. So today, if we went forward 20 years into the future and the tax rules were the same, there might be a route for you, Justin, if you weren't working elsewhere, to get £50,000 a year out of the company with just 7.5% on 35,000 of that.
Brilliant.
But of course, I can't guarantee that by the time you want to take the money out.
So a lot can happen between now and then. But no, thank you, Peter. Thank you again. For anyone that's watching, of course, talk to your accountant or talk to Peter for further advice, because it's all going to differ slightly depending on your situation as to whether you should buy in a personal name or a limited company. I hope this video is helpful and kind of answers some of those questions that are out there at the moment. And until the next video, we'll see you very soon.